So you are thinking about buying a house in Fayetteville, North Carolina. But whether you are a first-time buyer, a seasoned veteran, or someone who's just investing, I'm going to give you 10 steps that'll help you make your transaction a lot smoother. Hopefully these steps will save you a lot of money, time, and stress. So without further ado,
let's fucking go.
I'm James, your local realtor. And if you're thinking of buying, selling, or investing in the Fayetteville surrounding areas, please reach out to the team and me. We would love to help you. So let's get started with these 10 steps. Now, I know I said if you're buying a house in Fayetteville, North Carolina, but these steps will help you across North Carolina, because I know buying a house is a big deal and it's the biggest purchase of your life.
These ain't opinions. These are facts.
Now, these 10 tips I give you are going to come from personal experience of helping tons and tons of sellers and buyers and investors, and I'm also an investor myself. This is going to be a long video, so I suggest you grab your popcorn, beer, cup of coffee, and let's go ahead and get started with tip number 1.
Few moments later.
Sheriff, he's over here. God.
And that is getting your finances together. So you definitely have to make sure you have enough money to put down for a down payment, closing costs, things like that. You gotta look at your debt to income, your credit history, and your job history. A lot of people think when they go to buy a house that, some of them tell me that, hey, my credit's good, I know it's good, I've kept it up for all these years, which is fantastic. But getting a loan, they do not only look at your credit, they look at your job history, they look at least 2 years of job history, and they look at your debt to income. So your job history, let's say you are a nurse and you've been a nurse for the past year. Then next you decide that you're going to become a firefighter. Well, still job history, which is good, but your salary has definitely changed from being a nurse to being a firefighter. So sometimes that could hurt you because they look at your taxes and things like that. Definitely, I would say speak to a lender about that, but I've seen it hurt a lot of people in the past. Other thing is your debt to income. A lot of people think it's just about credit, like I said, and it's not just about credit. It's about your debt to income too. If you've got a lot of debt, if you got a lot of school loans, car payments, credit cards, things like that, too much debt could hurt you. Where the bank feels that if they put a home loan on you also, that's going to make you go bankrupt. They're not going to do that. They're not going to give you a loan if you've got too much debt, even if you're paying everything on time.
This is going to cost you. Put it on my tab.
So with your debt to income, they typically look at it at least to be 40 or 35 ratio or below. Anything higher than 40, typically they do not like. It depends on each lending company, things like that. Your bank, don't just quote me on that. Definitely get with a lender to find that out for sure, because each bank is different. So your next question is, what you need to save up for? Well, you're going to need to save up possibly for down payment, unless you're getting a loan, like a VA loan is 0 down payment. FHA loans are 3.5% down payment, and conventional loans are 3% down payment. USDA loans, which I've not seen a lot of people use, those are 0% down. I'll get into the loans as one that's, I think, going to be step 3, maybe 2, but we'll get into the loans in just a second. So you're going to need down payment for that. So if you're going, we'll say FHA loan, and you're getting a $300,000 home, that 3.5% down, you're going to need at least $10,500 for a down payment. Then you possibly will need closing costs. That could be another $10,000. That's about $20,000 right there off the bat that you may need. I say may need. You may not need it because you could be getting a 0 down payment loan. You could have the seller pay your closing costs. Also, a new thing that just came out recently at the time of this video, of course, depending when you watch it, you may have to start paying a buyer agent commission. And what I mean by that is this: typically in the past, what has happened is the seller of a home pays for the commission of the buyer agent. So let's say you're buying a house and it's $300,000. Typically, when the listing agent lists that house, they list it for, we'll say, 5 or 6%, and they split their commission with the buyer agent. Well, recently that has changed with NAR, National Association of Realtors, to where now they are saying that the buyer has to pay for their own buyer agent commission, possibly. Of course, if the seller still agrees to pay for it, fantastic, or some of it, then that could play in a factor also. But typically, it's going to be 2.5%, 3% of the sale price of the home. So we're talking another $10,000. So right now we're up to $30,000 you may have to bring to the table. And I've not even talked about due diligence money, earnest money, or home inspections and termite inspections. And I'll get to that tip in just a bit. So let's say you get the $30,000 just for argument's sake, and that's just in case. And so you're set to go now. So the next step is hiring a realtor. So hiring a realtor is very, very important. I'm a real estate agent here in Fayetteville and the surrounding areas. That's how you're watching this video. You found me on YouTube, but definitely do your research. I'm not saying I'm the right person for you, but I would love to help you if you're looking to buy, sell, or invest in the Fayetteville surrounding areas. So when you're looking for a realtor, definitely get online, see how long they've been in the business. I'm not saying that a new agent is not good enough. I was a new agent at one time also. Started 5 years ago. So definitely a new agent is. There's not nothing saying they don't know what you're talking about. But definitely things I look for is I would look at how well they know the area, how long they lived here, and how many sales and things like that they've had. Negotiation skills, communication skills, very, very important. If you can't get a hold of your agent, we've got a problem. And I've had a problem myself getting a hold of agents. I've called, text agents, emailed them. Sometimes they get back to me, sometimes they don't. It's very frustrating. But it's just the way it is, unfortunately. Make sure you've got a good agent who's going to respond back to you. The other thing I just mentioned earlier is the listing agent. So a listing agent is somebody who's selling the home. Let's say I'm selling 123 Main Street. Well, not me. Let's say I'm the real estate agent, listing agent for 123 Main Street. And let's say the seller hired me. So now I work for that seller. I am trying to help sell their home. Of course, you could use me too, and that'd be called dual agency. And that means I represent both you and the seller. Until it's in writing, right now is just a verbal agreement, and I have my fiduciary duties to my seller, not to you, to my seller, because we have not signed anything on paper. So be careful of that if you call the listing agent. You want to make sure that you don't tell them things that you don't need to tell them, like you're willing to pay over asking price for the home or things like that. They don't have to keep that stuff confidential. They can go back and tell their seller, and they probably will. I would, because I'm working for my seller. Now, definitely get it in writing that they're representing you and the seller. Then stuff like that, then they owe you fiduciary duties. They must now keep things confidential that you don't want them to tell the seller, and vice versa. Now, my recommendation to you would be to hire a buyer agent. I know I said earlier you may have to pay for one, but I would definitely recommend it highly, because you know what, the listing agent, it doesn't have any ties to you until you sign that form. So if you would save money with going to the listing agent, because now they're working both sides of the deal, but that's not always your best choice. I would definitely see if that agent has somebody else they could recommend to you and get a buyer agent, or go find your own. That's just my recommendation. You guys are grown adults. You're looking to buy a house. You do what you feel comfortable doing. I'm just saying, in my opinion, that would be the best bet, because now there's no, like I said, they're working for that seller. It's to me, they don't have any loyalty to you until you sign something on paper. And typically, you're not going to sign anything on paper. You don't know who you're working with. You're going to tell them, no, I'm not going to sign anything with you. Now, I don't blame you. I wouldn't either. So just be careful of that. That's just my opinion, of course. You take it how you want to take it. And do your good research on an agent. If you find an agent, like if you Google my name, if you Google James Walker, real estate agent in Fayetteville, you're probably going to find me all over the internet. I have a Google business page. I have a Facebook page. I have an Instagram page. I have a YouTube channel, obviously, because you're watching this video. I've got my own website. Me and my wife are a team. We're part of the All-American Real Estate Group with the XP. I've been here for over 35 years. I'm a retired police officer. I'm not going anywhere. I'm going to be in Fayetteville for a long time. So I've got a lot of ties to the community. And I'm not saying that so you could hire me. It may not be your fit either. I may not be the person for you. We may not click together. And that's all right. That's okay. That's all right. I mean, nothing's going to be perfect. Definitely do your research, I say. Make sure they're a good realtor. They, look at their Google reviews. If they have any Google, look at their Zillow reviews, things like that. See what they're posting on social media. And another good thing about hiring or looking for a buyer agent is they could help you find a good lender. Typically, like I work with about 3 or 4 different lenders that I work with a lot, and I trust their work, and I know they're good lenders. I'm going to keep using them, and I may get more in the future. It usually happens. So definitely that agent can help you find a good lender, and somebody they trust and that they're good working with. They don't get any kickbacks for using a lender. They're not allowed to. We're not allowed to in general. So it's just more of a relationship of, yes, they like working with that person. They know they can count on that person. I got lenders. I can tell you 3 right now. I could probably, it's Saturday at 6 o'clock, 7 o'clock. And I could probably call all 3 of these lenders on a Saturday, and they would answer their phone and see how they can help me or help you. So it's not, there's some lenders I know that they just don't work weekends, and that's fine. They don't have to, but I don't need somebody who's going to be on my schedule, work when I work. All right, next thing new is finding a lender. So whether you get a real estate agent that you've hired to find a lender for you, or you find your own, that is your next step. And definitely shop around. You definitely want to not just go with the first one that you meet. Not saying that's a bad thing, but compare prices. Interest rates are going to be the same regardless typically. What happens is some lenders may have some kind of incentive or promotion they're running where they can buy back points and make your interest rates lower. Where they're going to give you a down payment assistance, or they're offering to pay the appraisal, things like that. So definitely look out and have them compete with each other. I've seen, I have one story where a guy was pre-approved with one company, and he went online and checked with another company, and their rates were better, and he went with the second company, and we were already in their contract. It's okay to switch lenders, but make sure it's at the beginning of the contract. Switching lenders after you're under contract can be a little hinky, a little, it could delay things, and then in turn could piss off the seller. So make sure, if you do something like that, and I know I'll probably put a cart in front of the horse, it could get, delay things, but that's another story in itself. So, definitely shop around for a good lender. Make sure it's somebody you click with, somebody you can get a hold of on the weekends, because most clients are going to look at homes on the weekends. And if you see a house, and I'm showing you a house, and it's Saturday at 5 o'clock, and you're like, James, let's put an offer in right now, and we can't go hold of your lender because I need a pre-approval letter, we may have some problems. Now, they can, of course, send you one pre-approval letter before the weekend starts, but you may have some questions. You may ask me, what's my mortgage payment going to be, James? I don't know what it's going to be. I could do some math for you and give you a rough estimate, but your lender is somebody who can give you, basically almost to the dollar, to the penny of what your mortgage may be, closer than I would be. You may have some questions I can't answer that the lender could answer. I'm not expecting you to call them at 2 o'clock in the morning, they're going to answer the phone, but at least get a hold of somebody who's not at a bank, who only works on weekdays, 8 to 5, and you don't have their cell phone number. The lenders I use, like I said, I can reach them almost any time if I really wanted to.
Hello. Is it me you're looking for?
I know I talked about this earlier, and tip 1, I'm going to hit it just a little bit here. Debt to income, credit history, credit report, credit score, and your job history. So very important. They're going to look at all 3 of these things. Debt to income is a big one. Credit history's nice, job history's good too, obviously, but income is probably the biggest one they're going to look at, because they don't think you can afford to buy a house, they're not going to give you a loan. And need to get pre-approved. That's the only thing I can say, get pre-approved. There's no reason to run around thinking you can afford a $300,000 home. I don't know how confident you think you are, and that everything's great and you've got tons of money in the bank, things like that. And this is just a little reminder, if you are thinking of buying, selling, or investing in the Fayetteville surrounding areas, please reach out to the team and me. We would love to help you. We get phone calls, emails, text messages every day from folks just like you. So reach out to us. We'd love to help you. Our next tip I talk about is going to be the 4 different loans you can get. Now, I touched on this a little bit with a lender, but I'm going to hit on them a little harder, obviously, and talk about the loans. So the first loan, a lot of loans I see a lot around here, because obviously we're near Fort Liberty, Fort Bragg, is going to be VA loans. I would say almost 90% of loans I deal with, if not more, are VA loans. VA loans are 0 down payment. You put nothing down. Okay, so for example, you buy a house that's $300,000. They will loan you, the bank will loan you, if you're pre-approved for that much, the whole $300,000. You come out of pocket for nothing. Now, if we went FHA loan on that $300,000, FHA charges 3.5% down, not charges, but they ask for 3.5% down on the house. That's $10,500 that comes out of your pocket. So they only loan you at the $300,000. They're only going to loan you $289,000. okay, or 28,500, I'm sorry. If you went conventional loan, it's 3% typically, and it's going to be $9,000 with a conventional loan. So they're only going to let you borrow $291,000 because you've got $9,000 came out of pocket. USDA loan is just like VA loan; it's zero down payment. But I'm not seeing USDA loans only use those loans in agriculture areas. You can still buy houses, but it's mainly for rural and country areas. And not saying we don't have those anymore, but they're very tough and it takes a long time to close on them. I'm not seeing a lot of people use them lately, but they're still available. And definitely, if you'd like more information about each loan or in any of these loans individually, again, reach out to me. Be happy to explain them to you. Shoot me a call, email, or text message. I'll definitely answer them for you. You will get you in touch with a lender if you have this question I can't answer. Next thing I'll talk about is down payments. Now, we do have down payment assistance in North Carolina. The down payment assistance is called NC Housing, and they pay you up to $15,000 for your down payment. And that money can be also used towards your closing costs, which is fantastic. So let's say you get pre-approved for an FHA loan, and you have to obviously qualify for the down payment. With what they require, if it's not changed at the time of this video, is a 640 credit score or better. And you can't make more, I think it's more than $109,000 salary. So if you and your spouse don't make more than $109,000, you're good. I think it's $109,000. It changes. It's changing every year due to obviously with salaries and that increase or decrease. So right now at this time, I think it's $109,000, $110,000. Definitely, I'll find out for sure if you have a question about that. Now with the NC Housing, once you get qualified for that and they do approve you at closing, they're going to pay your closing costs. Any money left over is going to go towards your down payment and your closing costs. So you could be looking at getting into a house with no money down. Now, with a down payment assistance loan through NC Housing, if you borrow that money and let's say you decide to sell your house within the next 10, 11 years, you have to pay that money back to the state housing. They did not give you that money so you can go out and buy another house, unfortunately. What they're trying to avoid is someone like an investor who's looking to buy a house for a year or two and then turn around and sell it. They want to give this money to people who are first-time buyers, or someone, you don't have to even be a first-time buyer, but somebody who's looking to live in this house as a primary residence. They're not looking to help somebody flip a house. That's what the money is used for. So you do have to pay the money back. Of course, after a certain amount of time, I think it's like 12 or 15 years, I have to look it up again, that they will, of course, allow that to go away. I mean, obviously that's, after about 15 years, I think it is, that they won't ask that money back. So if you, in 15 years, you decide to sell your house, you're good to go. If you decide to sell it early, you will just have to pay that money back, obviously at closing. I'm actually going through that right now with one of my buyers. He bought this house 4 years ago, down payment assistance. Then it was only $8,000 that he borrowed. And 4 years later, he got married, had a kid, decided to get a bigger house, or needed a bigger house. And he used a down payment assistance program. He has to pay that back. Actually, he's about to pay it back in the next couple of days because we're going to close on his old house, moving to his new house. Again, if you'd like more information about down payment assistance, reach out to me. I've also got some other lenders that use a down payment assistance program that's not with the state of North Carolina, where you don't have to pay the money back. So next thing to talk about is going to be the VA funding fee and what that is exactly. So what is VA funding fee? The VA funding fee is a one-time payment that a veteran service member or surviving pays on a VA-backed or VA-direct home loan. This fee helps lower the cost of the loan for U.S. taxpayers since the VA home loan program doesn't require down payments or monthly mortgage insurance. The VA funding fee for regular military borrowers with no down payment, the funding fee is typically about 2.3% of the sale price of the home. The fee does increase to 3.3% for borrowers with previous VA loans, and for those with a down payment of 5% to 9%, the VA funding fee is 1.5%. Any loans with a down payment of 10% or higher will include a VA funding fee of $125. So that's what a VA funding fee is. Obviously, it's to help other veterans to buy a house in the future. So that's why you have to pay the VA funding fee. And the good news is that VA funding fee can be wrapped up into your loan. It's nothing you have to pay at closing. So if you got a VA funding fee at, we'll say at 2% of a $300,000 home, that 2% VA funding fee will be wrapped into your loan, so you don't have to come out of pocket for it. It's just something you pay as part of your loan. Definitely talk to a lender about that. And I think I want to say if you're disabled, if you're 10% disabled or more, the VA funding fee is waived for you. If that's still going on, last time I checked, that was still available. So next thing I talk about is going to be real estate terms. You're going to hear from a realtor, or you should hear from a realtor. In front of you, I've got a mortgage calculator, and this is what I'm going to do. So let's say the house is $300,000. Let's say going FHA loan is 3.5%. Let's say we do a 30-year mortgage, 7% interest. So with buying a home, you've got what they call PITI. It's property, insurance, taxes, and interest. Okay. So your property taxes, as you see here, I've got at $2,400. This is just a rough estimate. Each house is going to be different. You could have property taxes that are $1,000 a month. You could have property taxes that are going to be $3,000 a year. You can have some that are going to be $1,000 a year. Homeowners insurance obviously is going to be different also. I put $2,400, but it could be less, it could be more. We're just using this as an example. So I've got 7% interest. All those added up. Over here, you see this right here. So you're looking at a monthly payment of $1,926.05 roughly. Okay. I'm not a lender. This is a mortgage calculator that I found online. So for all you lenders out there or anybody else who gets their ass chapped when I do things like this, because it does happen, it's a mortgage calculator that I got offline. Anybody can do this. So if you borrow $300,000 and you got a loan amount of $289,500 because your down payment that you had to come out of pocket for was $10,500, total month payment is $360, total interest is $403,000, mortgage payoff is $2,054. Okay, so that's what you are looking at roughly when you get a loan. That's what your monthly mortgage payment may or may not be. It also depends on your credit score and how much you decide to put down. You could put zero down. Let's say we put zero down. Okay, with VA loan. Okay, payments change to $1,951.91. You know, that could make a big difference for you. So just think about that. That's a mortgage calculator. You can find thousands of them online, just to give you a heads up. We talked about closing costs. I'm going to go a little more depth about that. Earnest money, due diligence money, due diligence period, home inspections, termite inspections, a big old word called caveat emptor, which means buyer beware, appraisals, escrow, title search, and Fair Housing Act. So since I'm already talking about, last thing I mentioned was Fair Housing Act. Fair Housing Act is this. As a real estate agent, I am not allowed to give you my opinion about crime, what area is a good area or a bad area or neighborhood, schools. I'm not allowed to steer you into a certain direction that I think you should go. I'm not allowed to go, hey, this is a great neighborhood, you should move here. Because let's say I think it's a great neighborhood, and let's say you move there. Next thing you know, your car gets broken into, your son or daughter hates the school, you got drug dealers living next to you. And you're like, man, James Walker said this is a great neighborhood, he's full of shit. So, can't do that. I'm not allowed to say that. Can't give you my opinion. I can do this though. I provide data for you. I can give you a website for schools. I can give you a website for crime. And definitely, I would say jump on social media. If you're on Facebook, especially, if you jump in these groups, these Facebook groups where moving to Fayetteville, moving to Fort Liberty, whatever the case may be, you will find, if you go in there and ask a question, they will answer all the questions for you. And we've got a Facebook group myself, so if you want to join that Facebook group, it's right here in front of you. The link is, and it's in the description below also, so you can jump on there and ask your questions. I won't be answering them, unfortunately, but somebody else who is not a real estate agent could answer them for you. Next real estate term we talk about is due diligence period and due diligence money. So due diligence money is this. It's money that's non-refundable, that's given straight to the seller. So let's say you put an offer in on a house, and let's say you want to give due diligence money of, we'll say $1,000 to the seller. It's non-refundable. And that is money you're telling the seller, hey, I'm serious about buying your home. That money will come back to you. I know it's a non-refundable, but it will come back to you at closing. So how that works is, let's say you put an offer on a house, everything's good, we make it to closing. That means you don't back out. you get that $1,000 back, or whatever money you put into it. I say $1,000 just for a good round number. Okay, let's say you put an offer in, and let's say 2 weeks later you decide to back out. The due diligence money is now gone. They've kept that money. That's their money incentive for them to take the house off the market and be in a binding contract with you to sell their house. That means someone else can put an offer in. Well, somebody else can't put an offer in. They can put what's called backup offer, but they can't take the other offer, and get rid of yours. Now, of course, they can back out also for any reason too. You then do get your due diligence money back. They just can't take your money and run and put the house back on the market. You do get that back. But that's what due diligence money is, okay? If you back out for any reason, that includes if they don't do repairs that you want them to do. Nobody in North Carolina has to fix anything on their house. That's called, and that goes to my next word of caveat emptor, buyer beware. This is a buyer beware state. That means if you buy something, a house in particular, because we're talking about houses here, that be careful what you're buying. The seller does not have to fix anything, okay? They do have to disclose things that are wrong. Let's say the air conditioner doesn't work. Let's say there's a roof leak. You got a pipe burst and water's flying everywhere. You got electrical issues, and they know of these issues. By law, they are supposed to tell you. It's a material fact. Sometimes they may not know these are going on. Let's say that they don't know the roof's leaking because they've not been in their attic in 10 years. And it's leaking, and it's in the attic now. We get a home inspector, go in there and find out the roof's leaking, okay? So that's going down a rabbit hole, but just letting you know, they do not have to fix anything. They have to disclose things that they know of, okay? So let's go back to my original real estate term that I was using, which was due diligence money and caveat emptor kind of combined. So you put your due diligence money, $1,000 down. They won't fix the squeaky door that you want fixed or the broken window. And you're like, well, either they fix it, I'm backing out. Well, you can back out. They just kept your $1,000. It would probably be better if it's something minor like that, to get your $1,000 back at closing and get it fixed yourself. If it's something very drastic, obviously, then back out and you lose your $1,000, but it's better than losing a roof leak that's gonna cost you $20,000. Obviously, $1,000 you lose, it sucks. I got it, it fucking sucks. But it's better than paying for a roof that's $20,000, okay? That's just my opinion. Each house is going to be different. You talk to your realtor, or if I'm your realtor, we will discuss those things. So just be careful of that. That's why your due diligence money is very risky. We should do our due diligence, no pun intended, or maybe there is intended, of when we go to a house and you're like, hey, I like this house, let's put an offer in. We should look at this house very good and make sure what we can externally of everything. Roof looks good, HVAC looks good. Look at those things, two things, as best I can, because I definitely don't want you moving to a house and those things are horrible. I can't look to the wall, so I can't see electrical issues. I can't look in the wall, I can't see pipe burst and things like that. But the condition of this house overall, we want to make sure it looks good. There's always going to be an issue with a house. I'll tell you that right now up front. You're never going to get the perfect house. Even a brand new construction home is not going to be perfect. There are going to be issues with it because it's built by humans. No one's perfect. They can't build you the perfect house. Something's always going to be wrong with it. It's probably going to be minor if it's a brand new house. And they will fix those minor issues up to the first year. But, that for new construction. But, you just can't, you're not gonna be able to find a perfect house. That's the way it is. Now talk about due diligence money. Now we have due diligence period and earnest money. So due diligence period is, let's say we go on a contract today. And due diligence period could be, it's usually roughly 14, 15 days. It really depends on your realtor and you, how long you make it. I usually make it for an average, it takes about 30 to 40 days to close on a home. I'm gonna make it for about 15 to 16 days possibly. And in that due diligence period is when we want to get home inspection done, termite inspection done, appraisal done on your house. So if there's an issue, we have to fix it within that due diligence period. You can't come back after your due diligence period ends, that time ends, and go, hey, I want these issues fixed. They can tell you, well, they can tell you no anyway, but they can really tell you, no, you passed the due diligence period. So we get a home inspection, we want some issues fixed. definitely need to get in there with our due diligence repair request during that due diligence period and ask for these things to be fixed. So next thing is earnest money. Earnest money is just like due diligence money, but earnest money is given straight to the attorney. We always have an attorney close on a house in North Carolina. You probably heard the term escrow agent or something like that, or title agent or something like. Other states have different ways. In North Carolina, we have real estate attorneys, lawyers, closing on homes here. So that money, that earnest money, if you do decide to give any earnest money, like due diligence money, is given straight to the attorney. So let's say you put an offer on a house, same example, $300,000. You give $1,000 in due diligence, it goes straight to the seller. Remember, earnest money now, let's say we do $1,000 too, just for a good round number sake, we give it straight to the attorney. And let's say during our due diligence period, you back out. Now you lose that due diligence money, but you don't lose your earnest money if you backed out during due diligence period. Now I just talked about due diligence period. We don't back out. If you back out during that time, you get your earnest money back. You wait past due diligence period, you've now lost your due diligence money and your earnest money. And if I'm your realtor, I'm gonna make sure that we are good to go. It should be your realtors keeping track of that and making sure when your earnest money or when your due diligence period ends, they should be keeping track of that. At least I do for my clients. You shouldn't have to worry about that. You got enough things to worry about. So we talked about due diligence money, we talked about earnest money, and I know I didn't say this earlier, but I said $1,000. But there's really no set but there's really no set correct amount. It really depends on a house by house, case by case basis. The house has been on the market for several months. I'm going to tell you come in with a lower due diligence, lower earnest money, or maybe even no due diligence, no earnest money. I would say this right now, no seller is probably going to accept a house offer without some type of due diligence money, no matter how long it's not been on the market or how long it has been on the market. It's a risk for them to take the house off the market in 3 weeks, 2 weeks, whatever, you decide you're not going to buy the house. Now they lost time on the market and they got nothing to show for it. They've got no money for taking a house off the market. So they're going to ask for some type of due diligence, but you need to get with a good realtor and negotiate that. And I do that a lot for my clients. So definitely negotiating is a big deal. The house just hit the market 6 hours ago and you're thinking I'm going to come in with $100 in due diligence money. It's probably not going to work out well for you, because I don't think that seller is going to accept your offer with such a low amount of due diligence money. I would say this right now, if I was their agent, their listing agent, and we only hit the market for 6 hours, you came in with $100 in due diligence money, I would advise my client not to accept your offer. Next thing I'll talk about is going to be home inspections and termite inspections. So when you're buying a house in North Carolina, I recommend a home inspection. They're usually about $300-400 depending on the size of the house. Well worth it. Things we could not see internally in the walls. They're going to check the roof, the HVAC, the attic, the crawl space, plumbing, electrical issues, then look at the outlet box, all that good stuff. And it's worth the money. And then that's when we get our repair list. We found out from the home inspection what needs to be repaired or what should be repaired. Home inspection is not a test, it's a recommendation. They can recommend, hey, your roof's kind of damn old. You have to get a new one. You may want to ask the sellers if they'll pay for one. They may or may not pay for a new roof. New roofs cost a lot of money. They're running from between $12,000 to $20,000 now, depending on the size of the house. So it's something you need to consider. Maybe you should buy the house and back out. And then there's a termite inspection. They usually run about $85 to $95 depending on who you use. Termite inspections, we've got a lot of moisture here. We got a lot of termites here in North Carolina, unfortunately. So I definitely recommend it. And some lenders are gonna require it. It's only $85, $95, well worth the money, because if there's a termite issue, good chance we could have the sellers to fix it. Next thing I talk about is going to be an appraisal. So the bank's giving you a loan and they're going to send out an appraiser to appraise your house. Again, go back to the house that's $300,000 and they're going to make sure they're going to do their job to see if it's worth $300,000. They're going to compare it to other homes that have sold and other homes that are on the market, actively on the market, maybe some that are pending on the market right now, and compare it to your house. Now, not every house is going to be, exactly to the T similar, but if your house is 3,000 square feet, 4 bedrooms, 3 baths, 2-story home, they're going to look for a house that's 3,000 square feet, same amount of rooms, same amount of bathrooms. If you got 10 acres and they've got 1 acre, they're going to obviously deduct for things like that. Your house that you're buying doesn't have granite countertops, and the one they're using as what we call comp is that increases a lot of the money. If you've got hardwood flooring compared to carpet, if you've got a brand new kitchen that is installed compared to, old 1980, 1990 kitchen, then it's going to make a big difference there. So appraiser usually run about $800 to $900 to pay for. You have to pay for that, and the lender is the one who lets you know when the appraiser is going to go out there. You need the house to appraise, or they will not give you the loan. You cannot avoid that at all. And sometimes appraisals do come under asking price. So the house is $300,000. They may come back and say it's only worth $290,000. If they say that, then we have to see if the seller is willing to drop the price to $290,000, because that's all they're going to loan you. Now, I'm going through that right now. Well, we're going to close on it, but the house, my client offered $268,000 for the house, the listing price. It came back at $257,000. So that's $11,000 came under asking price. The seller home said, I will sell it to you for $262,000. He wanted my client to come out of pocket for the remaining money. I talked about it with my client. He really likes the house. He countered back with coming at $260,000, and they accepted it. So he's paying $3,000 more upfront for what the house is worth. It's only worth $257,000. They only loan him $257,000. $3,000 he comes out of pocket. That could happen. The seller could say, I'm not going to drop it at all, or they could drop it all the way to that price. He could have dropped it all the way to $257,000, would have been fine. But once your appraisal comes in, that seller at that house, what I usually tell them, hey, look, it's not going to appraise for any more. You could put it back on the market, but it's not going to appraise for any more, possibly, because the appraisal's already out there. It did definitely appreciate 10% in the past 2-3 hours. That's for sure. It won't appreciate 10% maybe the next 4 or 5 years possibly. So that seller's taking a big chance of putting it back on the market, just trying to get what he thinks his house is worth, or she thinks her house is worth. And their only hope is that someone is willing to either pay cash for the house or come out of pocket for the difference. Most people are not willing to do that because no one wants to pay more for something that's not worth that much. Next term I'm going to talk about is title search. Now, title search is when they make sure the deed is good and clean on your house. And what that means is that if you're buying a house from Aunt Sally and Uncle Bill and they haven't paid their taxes in the past 10 years, you want a title search to catch that, because the taxes on the house follow the house, not the person. So if you buy that house and you don't get a title search done, you're now incorporating their taxes that they own that house. So, title search is required, and the lender's going to require, and you have to pay for that also. It's definitely needed. You definitely don't want that to happen where they didn't pay taxes on the past 10 years on that house. Another good thing it protects you from is this. Let's say Aunt Sally and Uncle Bill sold the house they shouldn't have sold. Let's say their Uncle Bill's mom died and he sells the house. And next you know, his crazy cousin Eddie, who's in prison in Alaska, is out of prison, and it's like, hey, what'd you do with mom's house? You didn't have my permission to sell it, because they were the heirs to it. Let's say she willed her house to both her sons, crazy cousin Eddie and Uncle Bill. And now he's knocking on your door going, hey, this is my mom's house, get the fuck out. Well, title search is gonna protect you there, because they're gonna settle that with crazy cousin Eddie, and they're gonna go after Uncle Bill for the difference. So the next tip is going to be house hunting. And this is where the fun begins for you as a home buyer. So now you're looking for that perfect house or somewhat perfect house. And you need to decide, you should have decided way ahead of time of where do you want to live in Fayetteville or Hope Mills or surrounding areas, what size house you're looking at getting, square footage, bedrooms, bath, size of your lots. And the most important thing is your budget. Definitely do your research of the area that you're looking to move to. If you've got kids, you want to look at schools, you want to drive around the neighborhood, see what it looks like at night, during the day. See if your potential neighbors look like they've got a junkyard going on in their front yard. Their house looks decrepit and looks like the haunted house of the neighborhood, and you don't want to live there. Definitely do your research. Again, remember, Fair Housing Act, your realtor is not allowed to tell you or give you their opinion. You got to go drive around the neighborhood, take a look at the house. So next thing you'd want to do is put a list together of needs and wants. What you need compared to what you want. Obviously, the need part is what you need. If you need a 4-bedroom house because you've got a big family, then you need to look at houses that are 4 bedrooms or more. If you want a 4-bedroom house, just because you want a 4-bedroom house, it's not necessarily a need, it's more of a want, then that's what you need to decide on. What you don't want is the deal breaker is being a room that you want, or if you want a swimming pool, or if you need a swimming pool, make sure you set that aside and look at houses only that. If you need a garage, or if you need 10 acres of land. Another tip I give is you don't need to look at, I would say, a ton of homes. If you're looking at 15 to 20 houses, not saying that you can't and not saying your realtor won't show them to you. I've shown plenty of people houses up to 15, 20, but what happens is they start running together. You're going to forget house number 1 compared to house number 5, because you're gonna go, I can't remember what house number 1 looked like compared to house number 5 or house number 10. So definitely, there's a reason to look at a ton of homes. If you're liking house number 3, let's say, you want to keep looking because you think something better is gonna hit the market, it may or may not hit the market, but you're losing that chance of buying house 3 that's perfect for you or somewhat perfect for you because you think something better is gonna hit the market. Yeah, something better may hit the market, but if you just keep waiting and waiting and waiting, you'll never buy a house. Next tip is going to be putting in an offer. So you finally found a house you want, everything is great. Now put in an offer with your realtor. And I hope you find a realtor, if you're not using me or the team, that can negotiate on your behalf. You definitely want to look at time on market, ask for seller closing costs, ask for buyer agent commission. If you see a repair or something that's wrong with the house, you go there, hey, ask for that to be fixed, things like that. Also, you could be in a bidding war. So now you may want to come over asking price for the house. You may want to offer more due diligence, more earnest money, things like that. May want to waive some things too, that waive repairs. Definitely each house is a house by house basis, case by case basis. It's going to be all different. I would hope your realtor knows how to negotiate on your behalf, because if it's the house you like and there's multiple offers, he or she need to tell you, we need to come in strong with an offer if you really want this house. If you're like, I don't really want this house, then put in an offer that makes you comfortable. Don't go crazy if it's not going to make you happy. Definitely make sure you can afford it too, and it's something that you're not going to break the bank on. Make sure your realtor negotiates on your behalf in a good, strong way. All right, so now you put an offer in, now you're under contract. Now comes the stuff that I mentioned earlier with real estate terms. Now you need to set up home inspections. Maybe they're about $300-400. Termite inspections run between $85 to $95. Once you get those repairs back from the home inspection or possible recommendations or requirements, make sure your realtor writes up a due diligence repair form of those repairs you want fixed. And that's when negotiation comes in a factor, that they should be negotiating again on your behalf to make sure you get what you need, or try and get as much as they can for you. And this is where the appraiser comes in now too. The lender's gonna get the appraiser out there to make sure it's worth what it's worth. If it's worth $300,000 or if it's worth more. If it's worth more, great on your part. Now you're gonna get equity in your home. So let's say the house comes in at $305, you offer $300,000. We're not running to the seller to say, hey, your house appraised more, here's $5,000. No, we're not doing that. If it comes over asking price or over appraisal price, that's great for you. That's equity in your pocket. What is equity? You're probably asking yourself, maybe. It's now your house is worth $305. So technically you could buy that house for $300,000, next day sell it for $305. Probably wouldn't be a good idea, but that's the best example I can give you, is now worth more than that. Let's say you sell your house in 2 to 3 years. Now you remember, hey, my house appraised for $5,000 more. It probably, in 3 or 4 years, it probably went up a little bit too. So it actually appraised more for that. So it's a great deal for you. That's what equity is. Our next step is going to be what we call the final walkthrough. Now with the final walkthrough, what you're doing here is you're making sure any repairs you asked to be done are completed. Typically the final walkthrough happens about 48 hours before you close, 24 to 40 hours before you close. And you're also making sure no one broke into the house and stole your stove, your refrigerator, damaged the house, just being, buttholes, a bunch of stupid kids, stuff like that. The damaged house, you also make sure Mother Nature didn't take over. For example, a few weeks ago, we went under contract in the house and we had a real bad storm here, and we went to look at the house and there was water in the living room. And luckily it was nothing like a big puddle of water, but it was a new construction home. Kind of find out one of their doors was not very secure, and they fixed the issue and cleaned up the mess. So it wasn't a big deal, but that was just a final walkthrough. If we didn't do that, we would have missed that. New construction home, they would have fixed it anyway, but let's say it's a pre-sale home or a used home. Good chance they'd have been like, too bad, so sad. That's your problem now. So you always want to do a walkthrough before that. Mother Nature, make sure no one broke into the house, and make sure they did all the repairs they're supposed to do. And also you want to make sure they didn't inquire any new repairs. Let's say they're moving out their big old couch and they forgot to pivot and they hit the wall and now the wall's damaged. You want to make sure when they moved out they didn't damage anything else further and decided to say, hey, look, maybe they won't see this. Now you finally made it to closing. So what you do at closing is after you've done your walkthrough, you go meet at the attorney's office. Your real estate agent should be there with you. I'm always there at my closings, or somebody's there at my place. If I can't be there, like my wife's a realtor, either she will be there or somebody from our team will be there. And what you need to do is you need to bring your ID, closing costs, whatever it may be. If the house is $300,000, your closing costs could be around $9,000. Your lenders have to find that out for you. Your exact closing costs, you will know that before you make it a closing. You should, or a rough estimate, maybe off by $1, $2, maybe even $100. So make sure you have your closing costs. You probably want to get that wired to them. You can bring a cashier's check, but I recommend wiring the money to them. It's a lot easier and quicker, and won't delay closing. If two people on a loan, you want the people, everyone who's on the loan, applicants or co-applicants, bring your ID. If you got somebody on a deed who needs to sign but they're not on the loan, then you bring ID also. And you will sign everything at the attorney's office. Like I said, we have real estate attorneys closing in North Carolina, so we'll all meet at the office. You sign everything, and it takes about no more than an hour typically to sign everything. There's a lot of paperwork, but the attorney's probably going to go through it very quickly. If you have a question about it, obviously ask, but they're not going to read every page sheet, because they did, they would be there for hours and hours and hours. Now, just because you signed everything doesn't mean the house is officially yours yet. It sucks, I know. Give you another story. My wife went through that this weekend. Closed on Friday at 1 o'clock, and the house did not record. What I mean by record, it has to record at the Register of Deeds at the courthouse. So what happens, they sign everything, all the paperwork is sent to the Register of Deeds electronically, and then now there's a queue line, there's a pecking order. So if you're not the first one and you're the third one, good chance that you may record that day, but let's say you're 20th in line, then good chance at 1 o'clock in the afternoon, you're not going to record that day, I don't think. It sucks, and the house is not officially yours. And unfortunately, her clients signed everything on Friday, and they were hoping to move in this weekend. It didn't happen, so now they have to wait till Monday for it to record. The whole weekend shot for them. Unfortunately, they understand, but it sucks. I hate it for them. They hate it for them too. It's just a weekend loss where they could have moved in. Now they can't move into a new house. It's just sitting there. Unfortunately, that's how North Carolina does it. I know other states do it different ways, but welcome to North Carolina. It has to record first. If you're going to record, try and record first thing in the morning. Good chance it will record the same day. Not always, but if you record at 9 o'clock in the morning, you've got all day to have the house records. Or, maybe record the day before, late in the afternoon, then there's a good chance you will record the next day also. What I want you to see is you got your buddies and you got beer, pizza, and a moving truck, and you're ready to move in, and you can't move in. So your realtor should be explaining this to you, if I'm not your realtor, that it needs to record first. Well, if you enjoyed this video, please check out this video right here that YouTube recommends to you. And if you're thinking of buying, selling, or investing in the Fayetteville surrounding areas, please reach out to the team and me. We would love to help you. We get phone calls, emails, text messages every day from folks just like you. And I answer every phone call, every email, every text message personally. I'll see you guys in the next video.